Let me start with a number that stopped me this weekend. The S&P 500 closed Friday at 7,354, down 2% for the week, down 3% from its all-time high. A week where the Nasdaq lost 4.6%, a week where the Mag 7 shed roughly $500 billion in market cap. And yet, the prediction markets give the S&P a 66% chance of hitting 700 to 800 by New Year's Eve. That's a 6% rally from here in the next 6 months. So we've got a week that felt bad and a forward view that says things are fine. That gap between what the market just did and what it's expected to do is what we're unpacking today. Let's start with the week that was. Friday's close. S&P 7,354. Nasdaq 25,298, lowest in 2 months. Dow 51,976, up 1.7% for June. 11 sectors, 8 of them positive. Industrials, energy, healthcare, all caught a bid. And the S&P still finished down. That math only works one way. The Mag 7 are dragging everything else. Wednesday was the worst session. The Kospi triggered a circuit breaker. Korea's tech-heavy index crashed 8%. That contagion hit our semiconductor stocks directly. The SOX fell 7.9% in a single day. If you're new here, subscribe. Pinned comment has the watch list. Now let's look at where we actually sit across 3 charts. Start with SPX. Daily chart. The index is at 7,344. Short-term trend sits at 7,439. Medium term at 7,117. That 300-point gap between price and the short-term line is the damage from this week. But look at the 1-hour chart, and the picture gets sharper. Price at 7,354 is sitting right on the lower rail at 7,350, practically touching. The short-term trend on the 1H is at 7,374. Just 20 points above, so the S&P is compressed into a 24-point band. That's a tight range. The next move out of it will tell us direction. Nasdaq side, let's look at QQQ. Daily chart, 706.52. Short-term trend is at 721, well above price. Medium term at 663. The daily picture is clear. Price is below the short-term trend. That's a breakdown. On the 1-hour chart, QQQ is at 706.69. The lower rail is at 705.97. Again, practically touching. The short-term trend on the 1H sits at 714. So same setup as SPX, price pinned against the lower rail with trend above. Now VIX. Headline number 1841. That is not a panic reading. On the daily chart, VIX sits below its medium-term trend at 19.50, above its short-term at 17.87. The lower rail is at 15.67. Nothing alarming on the surface. But the 1-hour chart tells a different story. VIX at 1841 is trading below its short-term trend on the 1H at 18.89, but well above the lower rail at 15.82. The structure is tighter here. Volatility is compressed. What that tells me is, the VIX itself isn't panicking, but the options market has been pricing risk at levels we haven't seen since March. So here's the divergence. SPX and QQQ are both testing their 1-hour lower rails. VIX is quiet. That's a market that's on edge but not in panic. It could break either direction. Now for the mid-year outlook. And this is where the data gets interesting. Kalshi's prediction market shows the S&P 500 has a 14% probability of closing 2026 between $7,800 and $8,000. That's the highest single bucket. Above 8,200, 11%. Above 9,000, 4%. Polymarket is even more specific. They price a 66% chance of 7,800, a 36% chance of 8,200, and a 14% shot at 8,600. For the NASDAQ 100, Kalshi's highest probability single outcome is the index above 33,000, a 13% rally from 29,118. The implied probability on that is 22%. The banks agree. Citi at 8,100, Wells at 7,050. JP Morgan and Barclays at 7,800. Wolf Research is bullish on the second half. Lower oil, strong earnings, continued AI investment. The consensus is moderate upside. Nobody's calling for a blow-off top. Nobody's calling for a crash. The range is basically 7,800 to 8,100. But here's what keeps me up at night. Bank of America reported that technology funds saw a record $93 billion in outflows last week. Largest weekly tech outflow on record. And the week before, equity funds saw $119 billion in inflows. Also a record. Almost $200 billion swung in 2 weeks. BofA's Michael Hartnett called it a risk-off summer preview. The rotation from Mag 7 into AI infrastructure and small caps is real. And the 3 catalysts are real too. The Fed turning more hawkish, sticky inflation data, and profit-taking in semis after a massive run. The Fed backdrop matters here. June FOMC was 12-0 to hold. Half the committee now sees at least one hike in 2026. The median dot moved from 3.4% to 3.8%. The market is pricing about 41 basis points of tightening by December, nearly 2 hikes. Warsh said he won't tolerate high inflation and dropped forward guidance entirely. The market has to price off the data now, not the Fed's word. The counter-argument, and it's real, is that oil is back below 70. If that holds, inflation expectations come down, and the hiking pressure eases. But oil got complicated over the weekend. Saturday, the U.S. struck Iranian targets again. WTI at 69 on Friday may not be the WTI we see Monday. Quick pause. Drop a comment. Prediction markets at 7,800, or the bond market pricing 2 rate hikes. Which one are you leaning into? Here's the bottom line. The market is telling us 2 things at once. The short-term data, fund flows, Mag 7 repricing, rate hike expectations, all point to a defensive posture. But the medium-term data, prediction markets, bank targets, point to a higher market by year-end. Both can be true. What matters is the path between them. This week, watch 3 things. SPX at 7,350. That lower rail is make or break. QQQ at 706. Same story. And Friday's jobs report, the catalyst that could tip the scales. Subscribe if this helped. Watch list link in the description. Trade safe.